Brad Laddusaw here, President of the California Mortgage Association. We're here in Monterey, California for our fall conference. I have John here with Fidelity Mortgage Lenders. Oh, I got it right. I've known you for a couple of years now. I better get this shit right. Would you mind taking a few seconds to introduce yourself and your company?
Yeah, sure. So John MacLean, Fidelity Mortgage Lenders. We are kind of the original private lender out of Los Angeles. Uncle Chuck is the founder. He's still in the office every day. And he started back in 1971. So we've been doing this a long time. Originally, it was Fidelity Home Loans. So I think originally we were doing second trust deeds when probably all of us were little kids potentially that are watching this. So that's what Fidelity was doing. Now we have about a $330 million portfolio. We service everything in-house. We've got about 550 loans. We do mostly commercial. About 75% of our portfolio is commercial loans, meaning like office, retail, industrial, all of that stuff. Okay. Not so much just 10-unit or 20-unit apartment buildings. We can still we'll do single family, 1 to 4, business purpose rental properties. We don't do any consumer loans at all. We've been doing this for a long time. We've got a loan officer down in San Diego and the Bay Area, also our team in LA, and we're doing loans Western states. So we're kind of covering most of the business we do is in California, but we are doing loans in Texas and Montana and Colorado and Oregon and Washington. Yeah,
out of state.
Yeah.
So when did you guys make the decision to start going out of state?
Well, we've been doing out of state. I think sometimes it's
and this
probably
is unscripted. So
no. This is it kind of happens. I mean, it happens when you have a transaction that makes sense, right? Yeah. So I mean, I've right now I've got 2 loans I'm working on in North Carolina. So we've never done. I shouldn't say never. Chuck's probably maybe done a loan over the 50 years, but. We're looking at 2 transactions in North Carolina right now that we normally wouldn't do, but it's to a borrower. I did a loan for him in Texas. Big, strong guy, and he's got 2 free and clear industrial buildings in North Carolina, and he's like, "Hey, I need about $1 million." Yeah. So yes, we can do it. It's also a trust deed state, so it's like, okay, we'll figure it out. We'll figure it out. So we have our attorneys too, so we'll coordinate our loan docs, all of that. And again, if it's an easy enough transaction, we've got a few loans that we've done in Hawaii.
Easy, that's a dangerous word.
Well, keep in mind we're very low leverage. So we're kind of the original, 50% leverage is usually where we're at. When I look at our portfolio, like on the whole basis, we're like under 40%. Yeah, so we have a lot of really small loans.
But your yes means something. It's not that you're going to say, yeah, well, we might have a loan for you. When you green light something, you're rocking and rolling.
Yeah, we're good to go. We give a lot of quotes, and we'll hear from the borrower or from the broker. Oh, I need more leverage, and the terms are okay, but I need more leverage. And then a lot of those deals end up coming back to us.
Yeah.
So
don't negotiate against yourself.
Yeah, we just say we stick to our guns, and then we deliver.
Yeah,
we're able to deliver.
And then some of the terms, as in duration of loan, length, you're not just doing 12-month bridge. You guys are doing a little bit longer.
We do long term.
Can you break some of those down?
Yeah, we have kind of 3 different programs. We can do everything though, right? But we have a 5-year or up to 5-year interest only loan. Then we have a 15-year program. So it's 15-year, 30-year RAM, and we've got a 2020.
And these are on commercial assets.
These are commercial assets, and none of our loans have prepayment penalties. There's no personal guarantees, so we're just all about equity. And we do get a lot of nonprofits and churches and schools, different nonprofit entities. They're coming in because they can get a 15-year fixed with us. And there's no personal guarantee, so they don't need a board member to sign. So yeah, we get a lot of those.
Yeah, we've looked at a couple nonprofit. We're working on one right now, and that's the big thing with the board. It's like,
no one wants to sign.
Personally get,
right, no one wants to sign for it. Right,
nor should they. So being able to offer that non-recourse or no personal guarantee, but stretch the term out because they also don't want to be.
They don't want to have to refinance every couple of years.
Time.
I mean, there's points, there's fees, all of that. So, that's maybe a way that we're also selling our loan is that, hey, look, you're going to have the points now, but you can keep this for 15 years.
You're not doing it every 12 to 18
yeah.
months. We're going to have to redo it, and then there's market
Right.
shifts and things of that sort. And I call it life
Yes.
with investors in general.
Yes.
It's things change. So I don't like using the term set it and forget it, but as long as you're current on insurance, taxes,
Right.
and keeping the payments going, it's your investors are happy.
Right.
They
Our
get the money
investors,
working.
I mean, we have about 250 investors, and they've been with the company. A lot of them are probably 20-year plus. I mean, we've got 40 and 50-year investors, and this would be generational.
Yeah.
Chuck was dealing with maybe the grandfather who's gone, and then it's the father and now the son maybe. So we have multi-generational investors. So and part of that too is that we've got long-term money. They're not looking just to get the money. They just want to get those interest payments.
Well, and I think, and that speaks to what Uncle Chuck has built over the decades on that, and properly vetting investors as well. I mean, if I'm onboarding an investor and they're reliant on that monthly income from that trust deed investment, they shouldn't be investing in trust deeds in itself. And I laugh because you see the industry moves quick and it goes through cycles, and he's seen some stuff over the years, and he's willing to share it, I think, which is fascinating. But you have some self-appointed pioneers of the private lending industry. I'm like, you haven't even been through a cycle yet. Like, you're doing volume, but you haven't been through a cycle. How about, maybe you've been around since the 90s or 80s, and just don't self-appoint yourself on that. And I think with you guys, you don't. It's like, we perform, this is what we're good at, and we have a very competitive product. So if it works for you, great. We're going to be rocking and rolling on that. Question for you, how did you get into the space? You always been in the debt world, or where did
I was actually, it's funny, originally I was, after college and all, I went into loan servicing.
Okay.
And I was back at Home Savings, which is a long time ago. And Home Savings was acquired by Washington Mutual, which would maybe be a name that you'd be more familiar with. So I was on the loan servicing side. I ran foreclosure, I ran payoff. I had a lot of different areas over a 10-year term. And then with Washington Mutual, I was also a real estate broker, and my sister was doing apartment loans for Washington Mutual, and they were the #1 apartment lender in the nation. So I went to a couple of presidents clubs with my sister, and met up with the head guys there, and they're like, hey, you should be in sales. You should come on over. So they ended up talking to me about, they pushed me. What happened was they were big on the apartments.
Okay.
They were #1 apartment lender in the nation, right? So, but they were going to move into commercial. They knew I was a broker. They knew that I had rental property, and I was managing, large staff. So they brought me over to open up their commercial lending out of Pasadena. Okay. I lived in Pasadena. They needed a guy in the Pasadena market, and that's when the head guy, Al Brooks, said, hey, what about Anna, your brother? So I took a leap of faith. I jumped into it, and my first full year, I was #1 in loans, #1 in the volume, dollars, and I had the highest margins. And what I did is I marketed to all the branches rather than just sending flyers out, doing email blasts. And this was probably in 2005 or 6. So email was we were using that, but I went to all the branches. I sent a bunch of flyers out to 450 branches in Southern California, and I got flooded, and they had to hire like a couple of people to help me out.
You're like, I'm reaching under our current umbrella.
It's funny, when I went to, I was thinking about sending out these flyers to all the branches. And my dad used to work at Home Savings. Yeah. He had retired, but I let him know, hey, I'm thinking of doing this. What do you think I should ask before I do it? And he's like, no, you can ask for forgiveness. He said, it's brilliant though. You should probably do it. So I did that, and it took off, and the guys were like, wow, and of course everyone's asking, where are you getting all these deals in? And I would say the branches are sending them over, and they're like, those are usually kind of crappy leads. And I said, well, you weed through them and you get a few.
Well, it's a number.
But it's all connections.
Yeah.
And answering the phone and following up. That was the main stuff.
I think those two things, accessibility and answering the phone, but the follow-up. You and
Follow-up,
I could have a great conversation over dinner tonight.
Right.
And we had some good conversations in Palm Springs earlier this year. But if I'm not calling you a month after just to see how you're doing.
Right.
It's not even necessarily about where the deals are at, but it's what do you see in the marketplace?
Right. You got to stay relevant.
How's the family?
Right.
I'm going to this charity event. Do you want to go? Do you want to go swing the sticks? Even if I know there's a high probability you can't go, I'm not just, the purpose of my call is one, I genuinely want to know what's going on.
Right.
But it's staying relevant without being the bug on, hey, John, send me a deal.
Right.
Send me a deal. And it goes a long way. And the follow-up is the toughest part.
Yeah. And that's actually, like even from the banking side and the branch level, having somebody that they could call and that will take care, you think about somebody who's like a teller and somebody comes in, they're bringing their rent checks in and they're depositing and they want to maybe get a refinance or something. The branch just wants to make sure if they say call this person, or if they say I'll take care of it and have someone call you, they just want to make sure they get called back. So I was always big on making sure that I followed up not just with the customer, but I would always copy the banker. And so then I kind of had like the reputation of, hey, just call John and he'll figure it out. Even if it's deals we wouldn't do. Yeah. I had a transaction one time. This was back at Washington Mutual, and I had a branch call in to see if we could do a loan on an avocado ranch. Was this Chase? No, this was Washington Mutual. And no, we don't do an avocado ranch. It would be like an ag loan or something like that. But I still called the borrower back, and just as I was asking some questions, trying to figure out who I could send this transaction to, I just said, do you have any other properties? And she said, oh, we've got like a 60-unit townhome property in Chatsworth, but we have a loan on it. And I said, oh, where's the loan? And she told me that the bank. And I said, well, we're probably under that. So I ended up doing a $12 million loan on this property. I gave her about $1 million or $1.5 million cash out, lowered her rate. And it was an avocado ranch lead that came in. So, and I did actually refer the avocado ranch. I gave her a contact for an ag loan.
Get a little leverage on that.
Yeah, just saying that you could call these guys if you want to do an ag loan.
And I think that follow-up question, that still applies today. So we don't do ground-up construction loans. And a lot of times we'll get those leads that come in. First question, we're trying to make sure we're talking to the borrower. It's like, well, do you have a schedule of real estate? Do you have equity?
Right,
do you have rental properties?
To see if you have
because
anything else.
Potentially we could do a loan against your portfolio, lower leverage, more attractive pricing versus doing some crazy high leverage on a construction loan where you don't even have plans and permits approved. Like you're 2 years out from being there. And I think it's strategizing with them a little bit and sharing what you cannot do, but connecting them.
Right. And being, in a way you want that person, even if you can't do the deal, every time we get a call or a message to call someone back, I always look at it as, hopefully there's an opportunity, even though I'm looking at maybe what the message is, it's a property in Michigan and we're probably not going to do that. But, I'm trying to think, two sides of it. I'm thinking, is there anything I could do out of this? But the second also I'm thinking is there somebody that I could send this to? Because when if I send you a transaction or someone and you do a loan for them, you're going to appreciate it. You're going to be thinking like, I got to send John something back, or So it's all good marketing, and we're all trying to help each other out, anyways.
No, I think that's the beauty of CMA as well. And I always like to say, I don't know if I should say this out loud, but karma's a bitch. Yes. But she also works in your favor. Yes. So if you just do right by the people around you, it does come full circle, and you want to be the person that borrower or broker is going to call.
Right.
Ideally for not all their fires that they're trying to put out or all the issues, but even if they are, and you're able to at least connect them, it might be to an attorney, it might be to an appraiser. It's not necessarily about a loan, but then they'll be your next call on that side of things. So a couple more questions for you. We already established Fidelity's been around a long time. Uncle Chuck he won't say he's a pioneer. He's not going to tout his own horn like that, but he is, right?
He is.
There's a few of those guys that
I knew him back at Washington Mutual when I was there.
And then you recently started getting involved in CMA about a year and a half, 2 years ago?
Yeah, a couple years ago.
When you first came into CMA, what was your expectation? And then how has it actually been?
Well, let's see. I don't know if I had much of an expectation, but what I did find is it's very educational.
Yeah.
So I enjoyed that, and I'm still enjoying that aspect. And there's so many things going on. There's so many changes. It's hard to keep track of everything.
Scary.
I mean, what's funny is, keep in mind, and this is when Chuck was talking to me about coming over to Fidelity, and he said, look, you know, I know that you're the sales guy and you can run sales teams and all of that, which is important, but you got the loan servicing background that, you know, a lot of salespeople don't particularly have. But coming in and we've got all these loans that we're servicing, there's a lot of changes. And I mean, it's been about 15 years since I was in servicing, 15 to 20 really. It's nice to have the CMA monitoring everything and then giving these educational seminars. You know, there's just a bunch of changes on the 1-4 on foreclosures. And I'm like asking questions like, are we putting this disclosure in on our loan docs? And the answer is no one knows about it. So then I realized, okay, wow, I really need
I think we're on that webinar together in January.
Yes,
right
yeah, we
January.
were. We were trying to figure that out. And we don't do consumer loans, so I was trying to weed the difference between, okay, so what is this for? It's 1-4, but is this a consumer focus or is this a business purpose? And some of those requirements are both.
Yeah.
So I think that's great. It's totally needed, and everyone needs to be totally engaged on these seminars. You know, what we've got going on today. There's a lot of good information, and a lot of stories, you know, that are being shared back and forth.
No, and I think that's what, I mean, we're not going to go into the weeds on grenades we've gone through on deals, but I think with membership that has been lending since the 70s, 80s, 90s, some stuff that has popped up back then will kind of repeat itself.
Right.
And sharing some of those war stories, if you want to call it. It's like, here's a slight change you've done to underwriting to kind of snip that in the butt or catch it or reduce the risk of that happening again. And having that open dialogue is, I think it's surprising for a lot of first-time CMA attendees and members.
Right.
And then afterwards, like, why didn't I join 5 years ago
or
6 years ago? But Fidelity, you guys have been longtime supporters of CMA. You step up in a big way every year with sponsorships, and we cannot have these conferences, have these webinars without your support. So I just want to thank you in person for that, and we really appreciate the relationship we have. And I think we're going to be having a few beers later.
Yes,
so John, thank you for your time.
Beers, definitely.
All right, cool.